Good morning, everybody. Welcome to Bilkent University. Welcome to our finance workshop. Hopefully, this will be an inaugural workshop that will become traditional for our universities and especially finance departments or researchers who focus on finance to come and share their work together and get to know their colleagues. I'm very pleased to announce, and welcome you here to Bilkent. And without, with not much further ado, I would like to invite Professor Kürşat Aydoğan, to here for some opening remarks. Thank you.
My dear colleagues, first of all, I would like to extend our welcome to Bilkent University on behalf of the university. I'm very happy today to host this group in a workshop in our university on our campus. This one-day event put together by my friends is quite important in my opinion on several grounds. First of all, it provides an outlet for finance faculty to present their research to their fellow academics and hopefully get some feedback. This is, in my opinion, very critical in a time period when research in financial economics is becoming more and more specialized. Now, in our individual institutions, we may find it difficult to find a colleague who shares the same research interest as us. So this is a significant problem, and we may not be able to find colleagues to work with as co-researchers. So platforms like this workshop exposes our research to other academicians in the same area, and this will hopefully lead some collaboration in research in the future. Okay. Before coming here, I looked at the websites of the universities represented in this workshop, and I found that we don't have big finance groups in universities. Now, we are one of the bigger groups at Bilkent University, and we have only, 8 people in the area of finance. So this is not close to forming a critical mass in that area. We know that critical mass is very important. It enables us to go deep in research and also have sufficient breadth. And this is also true for educational programs. So when we have a bigger mass, we have better, we can offer different courses, offer different programs. In this workshop, we at least temporarily achieve a critical mass to share our ideas, both in research in other areas. When you think about it, you can imagine different areas of cooperation between our finance groups. First of all, research is quite obviously one of them. We can do cooperation with that. But another area of collaboration, possible collaboration, in my opinion, is the doctoral education. So almost all these institutions have their doctoral programs, and we are having problems in offering enough courses. An example of this collaboration is between us and Middle East Technical University, our neighbor. We offer our courses to each other. So doctoral students in each institution can take courses. So that reduces the burden of offering courses to a very small group of students. So that way we share resources. Now, I'm hoping that we will be able to find some time during the breaks to discuss these issues of collaboration among us. Now some thanks, first of all, to Tanseli. I would like to thank her and her colleagues who organized this event painstakingly throughout the last few months. She did everything possible with only one exception. She couldn't bring this nice autumn weather in Ankara for you. Unfortunately, it's a rainy day. For those of you coming from out of Ankara, we have a nice autumn here, nice fall, especially in our campus. But next time. And also, many thanks to everyone who are sharing their research here by presenting them, discussing those, and just participating. And I wish everybody a very successful workshop and see that it will be repeated in the future. As an anecdote, I've seen in many places when they organize an event like this, they always call it the first international blah, blah, blah. So she was modest. She called this finance workshop. But let's hope that this will repeat in the future. Thank you.
Okay, thank you very much for inviting me and giving me the opportunity to present this work. I haven't really done a 25-minute version of this, so I'll try not to go over time. So let me just start. This is also joint work with Atakan Yalçın from Özyeğin University. He's actually presenting this at another conference this weekend, so he can be here. So we're sharing duties here. Okay, so as the title says, it's a case against active pension funds. Now, some motivation. We've had the individual private pension system in Turkey since 2003. So it's been quite a few years, and as you know, the industry has grown exponentially. Partly due to the fact that the government incentives and the tax breaks are extremely rich. But the truth of the matter is we don't really know much about how these funds perform. There really hasn't been any academic studies on them. And most people have a hard time trying to pick individuals, trying to pick a fund, let alone decide whether to be part of the system or not. Okay, so our hope is to provide an unbiased analysis of these funds and hopefully help people make better informed decisions about their savings. Okay, so let me just start this by first a little bit of a disclaimer. As you know, the title of the paper is Case Against Active Funds, and this has attracted the attention of some people in the fund industry, and so they've sort of thought that we're against active funds in general, and I'd like to say that that's not really the case. But active and passive investing are both relevant and important strategies in terms of managing your savings. So I have a few quotes here. The first one is, says, a lot of people, myself included, have something of a gambling instinct. Can anybody guess who this is by? Okay, this was by Burton Malkiel, which I'm sure all of you are familiar with, the author of Random Walk Down Wall Street. He's a big proponent of efficient markets and indexing. So this was from an article in the Wall Street Journal last year. The article was called Investing for the Fun of It, and he was basically saying that he actually enjoys this kind of investing. Okay, so here's another quote. It says, "For your serious retirement money, you don't gamble." Can you imagine who this is by? Exactly, yes. I think you got the point. It's again from the same article, Burton Malkiel. So I think that's a very sort of balanced and mature way of looking at investing. So in general, active management may provide benefits to the individual and the society in general because it allows liquidity and information production. But we also have to, of course, judge it against the costs because active investing is not free, right? You have to put a lot of resources into managing a fund, picking securities, doing research, okay? So our hope is to sort of quantify the benefits, at least, as much as we can in this paper. Okay, so in the interest of time, I'll probably go over this very, very quickly. Overall, okay, what do we know about pension funds around the world? It's pretty much similar to what we know about mutual funds, and that is that they don't seem to overperform passive indexing strategies. Okay, that's not to say that every individual fund underperforms, but on average, okay, there doesn't seem to be abnormal performance. That's true of the US, it's also true in Europe. In general, we have less studies on pension funds due to data availability. So, there may be instances where pension funds might have performed better, but we don't really have a lot of research into pension funds, or at least I should say, not as much as we have on mutual funds. Okay, so let's get back to our work here. So our data is from a private data provider, Rationet, and they provide daily fund returns, asset allocations, okay, and also fund indices, okay, that they've put together themselves. This data is compiled from regulatory data, so it's very accurate, okay, and of course this is provided on a daily basis, and it's required for all funds, so it's completely selection bias free. There's no survivorship bias either. We have all funds that have ever existed, okay, and this is the whole universe. Okay, so any issues about selection or survivorship bias is taken care of by the regulatory environment in Turkey, which is great. Okay, our sample period is 2004 to 2011. We decided to use weekly frequency because daily returns, as you know, is quite noisy. And so since we had enough data, we decided to go for the weekly frequency here. We measure our weekly returns as cumulative returns from Wednesday to Wednesday, and that gives us 417 weeks. Okay. In total, we have 157 active funds. In the sample, there were only 2 index funds, okay, which is kind of surprising considering that index funds are so popular in the US and in Europe that our industry only offers 2. Okay. Of the full universe, 157 of them, which is pretty much all of them, basically are active funds. Now, the breakdown of these funds, of course, funds come in styles, and if any of you have put money into these funds, you know that you're offered some choices in terms of which type of fund you'd like to invest in. So the styles are what's called the flexible or mixed funds. Okay, these are basically funds that have the most freedom in terms of where they invest and how they invest. Okay, so there are 48 of these, 23 equity funds, 25 government external debt. This is Turkish government debt denominated in foreign currency. 32 government internal debt, again, Turkish treasuries denominated in Turkish lira. There are 9 international funds and 20 money market funds. Okay, now, I personally find that offering a money market fund as a pension fund choice is a little bit redundant, because if we wanted liquidity, then we wouldn't put our money in the pension funds. But I guess this breakdown probably represents what the consumers, the individuals prefer, and the fund companies probably cater to these demands. Okay, so that's something to think about. Okay, in the study we were using gross returns. That's returns before fees, okay, because we're interested in how much performance or how much value the manager is adding by active investing. Okay, so anything we report will be reduced by.
Which fees do you have in mind? I mean, the management fees, or there are other fees as well?
No, just the management fees. Okay, what they call fon işletim gideri. Okay, and that's usually about 2%. It used to be higher, but there has been, new regulation, and they've been kind of pulled down. I think there's a cap as to 2% now. So all our results are before that fee. Okay, so it's all gross returns. Okay, let me just start by some descriptive statistics. Just no fancy models or anything, just descriptives here. Okay, means and standard deviations. Okay, so if I take all of the funds and average their returns, and this is annualized, okay, it's about 11% return, standard deviation of 9.47. Okay, so you might say, okay, on average, a pension fund earns about 11% a year. That doesn't look so bad, okay? But I think the more relevant number is the benchmark adjusted return. All funds are required by the regulator to provide a benchmark, okay? So the funds choose their own benchmark, okay? They're not dictated a benchmark. Funds say that this is, let's say 40% of equity and 60% of some index, some maybe bond index, or so the fund basically reports a benchmark, and then it also reports the return on that benchmark, okay? So that benchmark is a combination of indexes, okay? So if you take the fund's return and subtract the benchmark return, that gives you some idea of how much the fund overperformed the benchmark. And on average, they haven't overperformed, they've underperformed by, about maybe less than half a percent there, okay? So if you look at the breakdown, you can kind of see that the balanced, flexible, mixed, this group, okay, remember, these are the funds that have the most flexibility, okay? And they don't report a benchmark. They're not, because they've chosen this style. They've earned around 10%, okay? Equity slightly bit higher. You can see the other numbers here. Now, if we just look at the passive indexes for comparison, okay, you can see this is our stock market index of the 100 largest companies, and the mean return of 17.78. So if you just offered an index fund that tracked the 100 of the largest companies in Turkey, you would have earned more than what these equity funds earn on average. Okay, and again, these are other indexes based on bonds. This is the overnight repo index. That's Turkish government securities denominated with a term of less than 1 month. This is all Turkish government securities. This is denominated in US dollars, and Euro bonds denominated in US dollars, and then this is the US dollar Turkish lira exchange rate. Okay? Okay, so this kind of gives you a very rough idea of how these funds performed. Okay? So far, I don't really see overperformance here. Okay, if you invested 1 lira at the beginning of this period, 2004, and rolled it over every week, okay, what we have on this graph are the fund indices provided by our data provider. These are value-weighted indices of pension fund returns. Overall, on this side we have the pension funds, on this side we have the passive indexes. So you can pretty much see a very similar picture here. Okay, this jagged line, those are the equity funds. Again, this jagged line, that's our stock market index. Okay, so again, this is not very, I guess, a rigorous comparison, but just to sort of get you to see that overall, what the funds tend to be doing is very similar to passive indexes. Okay, so let's, how much time do I have? 11 minutes, okay, I have to rush through this. All right, so first regression, I'm just going to regress the fund indexes on the passive indexes, okay? So each column is a different style of fund index, and those are my regressors, these are the passive indexes, okay? What I'm interested in is whether the intercept term is distinguishable from 0 or not, whether there's overperformance. And there isn't. The only one that's significant is this one, and that's negative, okay? All of the other ones are pretty much zero. So remember, these are not individual funds, these are fund indexes. So what this tells me is, on average, these styles of funds do not perform, any better than the indexes. Okay, so this is sort of the main regression of the paper. Okay, it's a slightly more complicated model because now I'm looking at individual funds. The question we're trying to ask is, okay, so as a whole, maybe they don't beat the index, but maybe individual funds do. So does the average fund beat the indexes? Okay, so what we have here is a random coefficients model. Okay, so we're estimating population parameters. Remember, this is a big panel, both time series and the cross-section of funds. We have 157 funds. So we have population parameters, okay, and plus the individual fund parameters. So the ones that are indexed by I are the fund parameters, okay? What I'm reporting here are the population parameters, okay? So these are the A, the alpha, and the betas, okay? This is the lagged returns of the funds as a control, okay? So we just run it 2 times, one with the lags of the fund returns, one without the lags. And again, no significant intercept term. Okay, so the average fund does not beat the index either, okay? This is the distribution of the alphas. Remember this, I'm reporting this population parameter, but each fund also gets its own intercept on top of that. So you can look at the frequency distribution of these alphas, and you can see that it's centered around 0. And that's sort of what you would expect from a random distribution of managers. Okay, these are the distribution of the slopes, which I'm going to skip in the interest of time. Here's an interesting one. What I do now is I take those parameters that I estimated, okay, and I ask the question, what explains the cross-sectional variation, right? Remember, there's some funds that do well, there are some funds that don't do so well. So how are the funds that are doing better generating those returns? What kind of risks are they taking? So this is a Feynman-Macbeth regression where I have returns as my on the left side, and on the right side I have these parameters that I estimated from the previous regression. Okay, and what we see here is that these are the government bonds, short-term and long-term, all of them. We get a significant coefficient on those. What that means is the fund's exposure to these Turkish government securities pretty much determines their returns. Okay? If you look at the equity beta, we don't see a significant coefficient on that. So that's kind of interesting because you would expect that the funds that invest, let's say, more in equity will have higher returns and things of that sort. We think this is probably due to the fact that actually very few funds invest in equities. Okay, most of the funds' exposure to equities is quite slim. And like I said, even the number of equity funds are small compared to the full sample. So we think that's probably why it's not coming up as significant in this regression. Okay, I guess I'm running out of time, right? 5 minutes? Okay, I think I'm not going to skip it, I'll just go this very quickly. This analysis is an sort of something we derived from the William Sharp's 1992 paper, Style and Selection. His original idea was to say, break the funds return into style and selection returns. Style would be the return you would earn if you invested in the, let's say, with the same sensitivities to the passive indexes, okay, and then the return you would earn on top of that would be your selection return. So we're going to do something similar, but we have one advantage, and that advantage is that we actually get to observe the fund's asset allocations, remember, because the funds are required by the regulator to report their asset allocations. We have access to that data, so that means we don't have to estimate their sensitivities to these asset classes. Okay, we actually know, you get to observe them, so there's no estimation error there. So then this becomes a very sort of simple exercise. What we're doing is we're taking the asset allocations of the fund in the previous week and imagining if you'd invested, and this is of course also something that you can all observe when you go on, if you've invested in the fund, you can go to the fund's website, look at their asset allocations, and then say, okay, if I invest with these percentages for the next week, okay, how much return do I get? And then subtract that from how much return the fund earns next week. So that difference will be the value that the manager adds, right? You could do the style return on your own. Okay, so how much value does the manager add? On average, 34 basis points. Not a whole lot, okay? Again, this is done for each individual fund, so some of them will be, this is sort of the grand mean. Some of them will be positive, some of them will be negative. Of the 152 funds, we find 14 positive selection returns, statistically significant, and 8 negative. So approximately 10% of the managers seem to be adding something. And that's probably not a huge number, okay? Okay, so this gets me to this question of why are these funds not so active, right? I mean, they consider themselves active, they charge fees that are commensurate with active management, but as we just saw, okay, they're not really providing a lot of sort of selection return. They're providing pretty much what we can achieve by passive indexing. Okay, so why are they not so active? There might be two reasons for this. One is they might be restricted by their benchmarks. Okay, so the benchmarks dictate pretty much what they can and they cannot invest in, on how much. Second, they may fear underperformance and may not want to deviate from those benchmarks or from what their peers in a similar style are doing. Okay, so this is what we're going to test now. So now, on the left side, I have the funds change in asset allocation for a given asset class. Let's say equities. So how much did I increase or decrease my weight in equities? That's my Y variable. On this side, I have previous week's change with respect to the average of the industry, and this is the difference with respect to my benchmark, okay? And then these are some other controls, returns from index asset classes. So in other words, if this is positive, meaning that I've, let's say, invested more in equities last week than my peers, okay? Does that change how much I'm going to invest, whether I'm going to pull back that overweight or increase that the week after that, okay? Okay, what do we see here? So this term, lag distance, average, it's this, the coefficient, this is beta 1. Lag distance benchmark, that's beta 2. Both of them are significant and negative, okay, for all of these asset classes. In other words, both of these two things seem to be going on. So the funds, if they deviate from their benchmark 1 week, they tend to regress to that benchmark the week after that. And also, if they deviate from what their peers are doing, they also tend to sort of pull back on those deviations. Okay, so this is some evidence of herding behavior among fund managers. Okay, so I'm running out of time, so I'll skip this one. So I'll just conclude. In any kind of test we did, we couldn't really detect any overperformance. Okay. We found that most fund managers cannot provide a selection return. They provide a style return. But of course, that style return, to achieve that, you really need an active manager. We found some evidence that managers herd, meaning that they try not to deviate from what their peers are doing. Okay. This result I haven't shown you, but in that table I skipped, we basically looked at how much return you would have earned if you invested in the top 10 funds in each year. And the quick answer to that is you would earn pretty much the average of the equity and the bond index. Okay. So how bad are these results? I don't think they're all that bad. They're consistent with what we've seen around the world, both in the US and Europe. So, if you're a fund manager, you don't have to be alarmed. Our industry is doing just as well as what's happening around the world. Okay. But there's an important policy implication, and that is where I think we're falling a little bit short here, and that's that we're not being offered enough index funds. Okay, so in all of these countries I mentioned, the UK, the United States, index funds make up of a large portion of the pension funds. Okay, and so I think we probably need the fund companies to offer these products as well. Okay, thank you very much.